Got the little live stream icon, which means I think we're live. This is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. He's in London, England. And our special guest today is Tim Melvin. How are you, Tim?
I'm doing fantastic down here in Greensboro, North Carolina today. Just did a high-speed drive across across the city of Greensboro because I was stuck in a doctor's meeting, and I forgot we did this live. So Toby can reschedule. We'll do it at 2 o'clock. And no, so we made it. So we're here. Thanks for having me. I appreciate it.
Yeah, good job,
Only
Tim.
killed three pedestrians and
Well, my wife just took the keys because she said I drive like a Texan. Well, she drove here like a Texan running for the border. So I mean, but we made it.
I love it. Tim, old friend of mine of ours, we've talked quite a few times over the
Yes.
years. Let's talk community banks. You've got a community bank investor newsletter.
Yeah, and we've been doing that one for a really long time, as you know. It's although you run across other stuff that's interesting. I mean, community banks have been my, greatest love since the early 1990s in the aftermath of the S&L crisis. And we just stayed with it. We've turned it very, very quant in nature. Because I know people that can go on these long esoteric lectures about banks and reserve banking and the SOFR EFFR spread and what's wrong with the banking system and this and the non-depository finance. None of it matters all that much. It is a lot of fun to talk about. Okay, especially some of the stuff with non-depository financial institution loans, but if there's a series of numbers, and if you get them right, you're going to make money. So
Hit
we
us with those numbers.
hit us
yeah.
with the numbers. Real easy. Capital levels. Okay. We want to look at equity to assets. We want to look at CET risk based capital. The higher that number is, the better. I'm addicted to converted thrifts. So, over 15 and 20, I will just own that stock and not part company with it because at that point, there's the cockroaches, Keith Richards, and that bank left after the apocalypse, right? So, so you want to have that buffer against anything that can go wrong because something's going to go wrong, right? Then the other is non-performing assets.
Mm.
Okay.
Right.
And what you're looking for here is you're just looking for bad loans, foreclosures that they can't get rid of. You want that number to be as low as possible. I use a cutoff of 2%, which in today's environment might sound a little high because we've gotten spoiled, right? Because they've been so low. But two's a hard percent cutoff. I mean, God could be running the bank. If he's got an over 2% NPA, I'm out. And I told that to John Allison one time, who does think he's God of the banking industry. I said, John, if you ever go 2%, I'm gonna have to sell you stock. He's like, Johnny's a good old Arkansas boy. He says, well, Tim, I don't expect we'll ever get there. I said, okay, well, good. Then I'll just hold. All right. But it's that those are the two key fundamental numbers that we're always going to take a peek at the amount of uninsured deposits. Just paying attention to that number kept you out of Silicon Valley Bank.
Mm.
Okay. So we're going to take a peek at that particular number. But then the only other number that we're really caring about, so if we've got a great loan portfolio and we've got lots of capital, most of this stuff in between doesn't matter that much. Okay. It matters if you're a professor or you want to pontificate. But if your idea was to make money in community bank stocks, then that's really just a lot of talk because everything's going to show up in those two numbers or book value. Okay. If book value is going south, something's wrong. No matter how good the story is, no matter how good the narrative, the stock might look, the momentum, whatever it is, all that can be excellent. If book value is going south, something's wrong. Okay. So we want to look for book value that's at least staying stable, and then price to book is everything. You make all your money in small banks when you buy them. And if you get that right, you get a bank with all the other criteria, and you can get that thing at 85% of tangible book value. And, I steal the phrase from Marty Whitman, but if you get all the other stuff right and you get the cheap price to book value, tangible book, by the way, it's going to be really hard not to make money.
So, uh, do you Do you find these banks have a lot of exposure to? So I'm not entirely sure what the reason Silicon Valley Bank fell over. That was more related to their asset side. They'd stuck it in treasuries and they'd had more front month treasuries that were very sensitive to the move up in rates. Is that
Yes,
that's what happened to Silicon Valley?
yes, but they also had the uninsured deposits were just these very large non-sticky deposits, right? And they were large deposits over the $250,000 mark. So once they got a whiff of a scare, they were gone, right? Because
I see.
they had no insurance over that level. Silicon Valley Bank's big problem was long dated, low coupon bonds. They had put all of their assets into that for the most part, and then they had
But those are safe.
Yeah,
well,
treasuries.
yeah, they are until everybody wants their money back, and then you got to take the mark on them. There was a whole combination of stuff that went on at Silicon Valley Bank that it was never a banking crisis; it was a regulatory crisis because in the rush to pass new regulation in the aftermath of all that, if you stop to realize that the regulators on all four banks had completely dropped the ball. I just said, oh, they own treasuries. We're not going to worry about that. So if you were following just the simple rules, you never got caught in that. And the same with Silicon Valley Bank at one time was a great bank. I can remember back in the 90s thinking I was a super freaking genius because I found this bank that was banking all the tech companies and they were collecting warrants, and I bought it at 15 and I'm a genius. I sold it at 45. And then I sat there calmly watched it to go to 600. But so yeah, if you get those numbers right, you're usually going to avoid most of the other problems that are going to come up in the banking sector. People overcomplicate this.
What sort
Is there
of, sorry, Jason.
more is there more or less economic sensitivity with the smaller regional banks compared to, say, like the bigger banks?
Less. I mean, the small regional banks, I think it's a wonderful life, right? That's kind of what we're going for is the Bailey
Yeah,
building the
with Jimmy
loans.
Stewart.
Yeah. Yeah. So they have no loans on large office towers and downtown buildings. And that's been one of the funniest things to sit back and watch over the last couple of years. Well, community banks have the massive exposure to commercial real estate. I'm like, yeah. And give me more of this. This is Joe's gas station and Fred's
Mm.
doctor's office, right? And a 4-story office tower on the edge of town that's full of accountants and doctors and lawyers and local advertising magazines and brokerage agencies and real estate firms. These folks were coming to work when they weren't supposed to. They never had the empty office problem. They never had the vacancy problem. There will be a rollover problem on the loans. That's a fact, right? You've got all this loan that was out there. Some of it's going to roll over. The rate will go up. That's going to be a very easy pass through. And indeed, when you look at commercial real estate loan losses in community banks, they're really low, right? Most of the problems in the banking area that you see, the commercial real estate office, it's at big banks. It's a big number, but it's a big number on a massive balance sheet. So I hate to say it doesn't matter, but it doesn't really matter that much. And it's the same with today's hot button, right? Non-depository financial institution loans. That's the bad word. And that's what's lending to private equity funds, to private credit, to commercial lenders outside the banking system, fintech lenders, which by the way is code for subprime in a suit. And
Is
there's
this
going
what
to
you would call the shadow banking systems now?
that's the shadow banking, and the shadow banking industry is banked by the banking industry. Okay, there may be some problems that show up there, but it's not the First Bank of Peoria's problem. It's Jamie Dimon's problem because all of that paper's on the larger bank sheets. For the most part, community banks take in deposits, they make local loans. One of the things I love, especially I deal in really small banks for the most part, they know the buyer, they know the piece of property, they know who the tenants are probably going to be. Right, they're very well associated with what's going on here, so they know the deals not to do and the deals that you can go ahead and maybe bend the rules on a little bit, which gives them kind of some insulation. What you'll see in community banks when the economy slows down is those with CNI heavy portfolios, commercial and industrial, they'll start to feel it, right? Because Rosie's salon has no customers and she can't make the payment. Okay, so we will see some of that. But even if you go back to 2008, when things were blowing up, it was only the banks that did stupid things that got into deep trouble. And by the way, all crises are created by banks. Every banking crisis is created by bankers doing something stupid. Right? If during the little 2023 banking crisis that really wasn't a banking crisis, where the 4 banks failed, and I forget who it was, but it was a great shot. It was just a shot of a guy from the knees down in khaki slacks, and he had cuffs on the slacks and tassels on the loafers. I just said, if your banker dresses like this, you don't have anything to worry about. Right?
What's the
So
old joke, Tim, about like the small town banker that
three,
won't
three, three.
lend
Is that
anything
it?
anything further than he can see from the top of the water tower?
Yeah, exactly. If I can't see from the top of the water tower, I'm not going to make the loan. And that is just a tremendous business. And it's not like I didn't discover this. Okay. People have been doing this for a very long time. And, everybody holds up Peter Lynch as the great growth stock investor, right? And I'm not taking anything away from Peter Lynch. He's one of the greatest investors of all time. Go back and take his fund returns apart. He owned, when he retired, right, in 89, was it? He owned every thrift in the United States because he had a guy that this guy's job was to go around the country and put money in the mutual thrifts so that when they converted, Peter could buy the IPO and hold the stock because that's layup money. The rules have changed. It's not as easy. But he owned literally every thrift. And if he could get them that met his guidelines, he continued to buy them right up to the day he left because at its core, small town banking can be a very good business. Now, right now, it is a much tougher business than it was back then because regulatory costs are higher. Jamie Dimon spends $1 billion a month on technology. First Bank of Peoria cannot do that. They have to go out. They have to find the licensing deals and agreements. And it gets very complicated now because when you go out and you acquire technology from a vendor, you're not just responsible for your employers to the regulators. You're now responsible to your vendors, to the regulators for your vendors' employees' behavior. So it's a regulatory nightmare. The other thing that we're seeing in community banks is succession. It's a problem. Right, we had a bunch of banks started in the 80s and 90s, particularly in the 90s after the Regal Act was signed by President Clinton. These guys are getting old, really old. They're older than me, old, and they're looking for a door. And nobody graduated Yale this past spring and said, "You know what I'm going to do? I'm going to go to work at a 3-branch bank in the Midwest." I'm super stoked. Not even the last guy in the class, the MBA class, had that type of brain. So succession's a problem. Now, so all of this.
I'm surprised that's not like there aren't search funds that are trying to do something about that. Because I mean, that sounds maybe more fun and interesting than going and running an HVAC roll up.
Well, yeah, but you get paid a lot more money to run the HVAC roll up. I mean, you want to have some fun.
Maybe.
You have some fun. You go in and pull the 10Ks and look at the salaries these guys are getting. A small town banker getting $250,000, that's top dollar. The smaller regionals, 400,000, 500,000, and dilute the stock with stock options and then go to the shareholders meeting. Okay. It's not good. Look, I've been to shareholders meetings in the basements of churches with these things. Okay. And it's all the local business people, and they know what you did, and they know who you did it with, and they know if you padded your own, pocket a little bit, and you're going to pay a price for it. So, but, what this is doing is and delayed, for a few years now, but it's kicking off another wave of acceleration of consolidation. Consolidation has been kind of grinding on, and then you'll get pickups under the Biden administration. And it's I don't care about the politics of it. They did not like banks. They did not like M&A. And when you put the two together, they killed deals that they shouldn't have killed. They killed a couple deals where I went through and I looked. I'm like, why did they kill this deal? And there was no reason. They just could. They drug their heels on others. It was a very hostile environment for banks and bank M&A. And again, politics aside, this administration is very friendly to banks. They're rolling back regulations. Michelle Bowman, whose family owns a bank in Council's Bluff, Kansas, Farmers and Drovers Bank, big bank. I'm sure you've all heard of it. It's been around for a long time and it's still only got 200 million assets. She's a community banker, right? She's worked teller lines. She kind of understands what it means to be a small town banker. So they're size fitting the regulation, and they're making M&A easier. And we're already starting to see it. I think we've had a sudden burst, and in the last few months, banks we've held for the last couple of years, we had 4 of them bought. I think 2006, you're going to see a real acceleration of this.
Do you want to get bought out, or do you just want to earn the ROE?
No, I want to get bought out.
Okay.
Buy me. Now, look, if you get the right buyer, right, then I'll hold the bank for a long time. I love telling the story about John Allison of Home Bank Shares. John, I wrote a bad article about his bank one day. I said stock was really expensive. And John Allison, if you don't know who he is, it's worth reading about him. But he and his partner, Bunny Adcock, okay? So you got Johnny and Bunny bought out a bank with FDIC assistance back in 1990 in Conway, Arkansas. Okay, small town, small bank, $25 million. Johnny's a really good businessman and he's a brilliant guy. So I wrote this article one time at Real Money and I said, hey, it's a good bank, but it's almost 3 times book. That's ridiculous. This man tracked down my phone number and called my cell phone on Saturday morning at 11 o'clock. I pick up the phone. I'm like, who the heck? I got a friend in Conway. I'm like, did Chris change his phone number? Let me see who this is. He's like, Tim, this is John Allison. I'm the CEO of that bank you wrote about yesterday. And I don't think you were very nice to me. But I got
bitch.
Yeah, that was implied, believe me. But I got to know John, and he's a great banker, and he does about a deal a year, and he's never made a bad deal. If John Allison buys one of my small banks, and it's happened a time or two, I keep the home bank shares that I get because it's a great bank. So you make the decision whether you're going to keep the acquiring bank on a case-by-case basis. But yeah, generally speaking, I want to get bought out. Absolutely, I want to get bought out. And you're looking at almost an arbitrage there of 85% or less of tangible book. Deals are currently averaging about 1.5. I will take that spread all day. And where it gets to be magic is if you can get it at 85% of book value and they grow the book at 10% a year. Okay, then big things start to happen.
Do you have any names, Tim, that you can take us through just to give us a flavor of what it's like?
I had pulled a couple up here. Let me just get back to the portfolio here. Bear with me 1 second, guys, because as you know, I was running very late coming in here today. There we go. Pull this up here.
Could I ask a more meta question before that while you're digging that out?
Absolutely.
If you think about, like, do young people have because I imagine that they're a little bit more inclined toward digital, a little less wanting to go into the bank locally. Maybe that's less important. Maybe I'm wrong about this, but I'm just imagining a less sticky customer base with the younger generation relative to maybe their parents or their grandparents. Is that intuition accurate?
Not really, because if you can, SoFi's figuring this part out, and we've seen some other banks figure it out. If you can meet their needs, right? In other words, don't make them come into the branch. Offer them the digital services, and it's a transition for a lot of bankers. But you have to get the tech right. If you get the tech right, they'll stay with you. Now, they're not old enough for this to be a definitive statement. Making a statement about the longevity of a 25-year-old would be kind of silly at this point in time. But it does seem that if you can meet their needs digitally, they will stay with you. And we haven't tested this yet, but we will in the next banking crisis that comes along, how soon they discover the importance of FDIC insurance. Although we've seen a little bit of that at SoFi. Their deposits went up when they started offering insured accounts, right? Something about Americans, we love that FDIC insurance, especially small depositors that really don't maybe not understand the banking system and how it all works. They kind of like the feeling that the government's going to back them up if things go wrong and punish the bad guys. So I think if you meet them digitally, they'll stay with you. However, if you cannot meet them digitally, you do have a problem, and that's actively driving M&A. Okay, and you'll also see the usage of AI playing a big role in this going forward too. But let's do some names now. Look, guys, the names I'm about to give you are small banks. Okay, if you use a limit order on any of the banks I'm about to tell you about, your major contribution to the day will be buying lunch for a trading desk at a small brokerage firm somewhere in the Midwest of America. Okay. And it's going to be the best lunch they've had all year. So, one of my favorites, and this is a former converted thrift, Toby, it's the North Shore Trust and Savings Bank. It's now called NSTS Bank Corp. The symbol is NSTS. It's a really small bank. It does not trade a lot on a day-to-day basis, guys. So please be smart, use a limit order.
Yeah.
But in a world where a 10 is a high equity to asset ratio, they have a 29. It trades at 70% of tangible book value. Okay, just a super cheap small branch, northern Chicago suburbs, former thrift. Trades by appointment from time to time, but you would have to work so hard to lose money in that bank. It's crazy. 2 days ago, I would have given you Blue Foundry Bank, but they got bought out. RBB Bank Corp out in LA. They are a Korean bank. They do business with the Korean American community, trading at 77% of book value, a 3% dividend, and a 12 equity to asset ratio. So,
when you see that equity to asset ratio, when they're more conservative like that, what does that indicate about what they're doing in the business? Why do they tend to run more conservatively?
well, they're more conservative. Okay. B, in the case of like NSTS or some of the other former thrifts, they took in a bunch of cash during the thrift conversion offering. And in a thrift conversion offering, here's what happens, Toby. We have a $100 million bank. Okay. We're a thrift. We're owned by our depositors. We decide to go public. Now, we have 100 million in assets, right? So we're going to sell 10 million shares at $10. That's 100 million. So at offering closes, what do we have? We have 10 million shares outstanding, but we have 200 million in assets.
Mm.
So we've sold stock at 10. It's now worth 20, but we've bought in just a ton of cash assets, and they tend to just kind of be there. And they'll just hold them in short-term securities, collect the money off of that. It is a very conservative approach to banking. It's a very old-fashioned approach to banking. But generally speaking, the banks that hold higher capital ratios are the ones that will not get in trouble when things do go bad. And as Charlie Munger said, you can make a lot more money avoiding stupidity than you can by being the smartest guy in the room. So bankers with high capital ratios, really conservative, happy to hold capital. The excessively high ones tend to be former thrifts.
So the RDB, which was was it RDB, the Korean American Bank?
RBB Bank Corp, yes.
RBB.
Yes. Yeah, and they're in LA, but they've got branches around the country, and I'm kind of shocked that they have not been purchased yet, because there's been a general consolidation among some of the more ethnically oriented banks.
And what's the story with RBB beyond they're well capitalized there?
Well capitalized. They serve the Korean American business community. I mean that is the story, right? That's a really loyal the Chinese American, Korean American banks on the West Coast, and there's some branches in like Washington D.C. I believe. They tend to have just this really super loyal deposit base. They come to them first for loans. So just a great business, but there's been a lot of consolidation in that space.
Why do they tend to trade cheaply?
Nobody cares about them. I mean, that's just bottom line. Nobody really cares about them. They see them as completely. If you just do it by the numbers, they're all commercial and industrial and real estate in LA. Real estate in LA causes cancer. We all know that. So,
It says it on the door.
says it on the door, right? There's a warning. So they're just, and all of the ethnic banks are trading very cheaply right now. They're just out of favor. Nobody's paying attention. They're not AI banks. They're not a sexy story. So everybody's just kind of standing aside.
And what sort of return would you expect absent the takeout in something like RBB?
Well, I mean, if I can get, it's going to trade up to book at some point in time when the banks come back into favor. If they can continue to earn a double digit multiple on ROE, then I think a double digit compounded return is reasonable to expect over time. That doesn't happen overnight.
And so, what sort of returns are they getting on equity or assets in something like that?
Let's take a look at RBB. RBB right now is doing a 7 on ROE and a very low ROA. This also makes them a very attractive takeout target. And RBB really, to me, is a takeout target more than anything else.
Okay. Let me give a quick shout out to everybody who's at home. JT's just fallen off briefly, so we'll see. He would ordinarily give us veggies at the top of the hour. He's back. Let me just do. I'll give a quick shout out, JT, and then we'll do some veggies.
Yeah, that's fine.
Lausanne, Switzerland. What's up? Surbiton, Cleveland, Toronto. What's GX? Barney, Main Street's a GX. You got to help me out there. Is that Georgia? Boise. So I got an instruction on saying Petah Tikva, and I've failed terribly. But Petah Tikva, what's up? Valparaiso, what's up? Kauai, good for you. Tallahassee. Monterrey, Mexico. Jupiter, Florida. Sam's already won. Toronto. Lisboa, Portugal. Fort Collins, Colorado. I think that's it. San Antone. Everybody's taking a break for Thanksgiving. JT, going to hit us with the veggies, and then we'll come back. We're going to talk small caps with Tim.
Yes, sir. All right. So today I wanted to hit us with what's new in Michael Mubison's updated capital allocation paper that came out a few weeks ago. So it's not going to be a full recap. It's just what's changed since the earlier version of it that I think I did a book report on already at one point. So the big picture is that this new data from 2024 and into 2025 makes the story even clearer than it was. That U.S. corporates right now are cash machines, really, in an intangible, heavy world with a lot of option value that's concentrated in a very small set of the mega caps. So here are 7 observations from the white paper. Number one, intangibles are now clearly driving the capital stack. 2024 U.S. corporate capital deployment was roughly $7.5 trillion. Intangibles, which are R&D and investment in the SG&A line items now, are 13% of sales and are bigger than CapEx now, which is saying something. So the center of gravity in the capital allocation universe has definitely shifted to the intangible world. Number 2, leverage today is lower than history, which might be a bit of a surprise to you, even after a decade of cheap money. So this is non-financial corporates debt divided by total capital, around 15% today, versus 26% historically. This has happened, after historically low rates, and so contrary to probably the usual narratives, the U.S. corporate is actually kind of entering the next regime under levered versus history. Long run return on invested capital, including intangibles, is around 9%. And that's basically they're generating more cash than they productively reinvest at this point. So it does tend to support these kind of structurally higher payout ratios. Excess cash and short-term investments are 7.5% of assets, up from 5.8%. So half of all the excess sits in fewer than 70 companies and a quarter of that is in just 10 companies. So the real capital allocation option kind of in the system is locked inside a very small group of mega caps, and their decisions are going to end up moving the whole ecosystem, really. So we got to kind of pay attention to that. Number 5 is the index is obviously flipped to intangible heavy sectors. So IT, healthcare, communication went from 26% of the S&P 500 in 1970 to more than 50% today. So now really like the benchmark itself is built on intangible heavy models. CapEx and R&D growth are effectively a four-firm story. The first half of 2025, CapEx is up 15% year over year. 60% of the incremental dollars came from Amazon, Meta, Alphabet, and Microsoft. So this infrastructure build out is in AI is very extremely concentrated. So basically, if you own or you're underweight those four, you're taking very specific capital cycle bets today, one way or the other. I don't know necessarily which one's right, but working capital is no longer much of a lever that it used to be. Net working capital fell from 30% of assets to sub 10% today. So that classic kind of like free up working capital play that was in the NBA playbook is mostly done. For many businesses, there just isn't really much juice left to squeeze out of that lemon. So summing this all up, more intangibles, less leverage, huge concentration of optionality and CapEx in a handful of firms. So as an investor, really that forces really a simple question, like what game are you actually playing in this world right now? Are you underwriting old school CapEx stories in an economy that's running, increasingly on code and customer acquisition costs? Or are you deliberately betting on a small handful of giants that will hopefully profitably deploy all these cash flows and this cash into a very uncertain AI future? So, with that, I'll let you gentlemen place your bets wisely.
What do you think? This one of the series that I tracks is margins for S&P 500, 400, 600, and they're clearly all of them are close to all-time highs, or they're all at all-time highs. And that Buffett comment, and it's been echoed by a few different investors. I think Jeremy Grantham
also, yeah.
and Hussman as well have all said anytime you see profit margins above 6%, you're likely to see some mean reversion. But the S&P 500 is at like 14, 14.9, like plus 14, which is more than 2 times, obviously, 6%. Is any of that...
The math checks out.
Is that a product of working capital optimization, or is that just they can charge higher prices that paying out less on the other side? Anything that you've seen that explains that?
I mean, you could reference James Monnier did a piece on this about it was a bit of a mea culpa. I think that was even in the title of it. Like he had predicted, being a GMO guy, that profit margins would mean revert, and this what he wrote in like 2012 or something.
Yeah.
And then he looked back at it a decade later, and they had not mean reverted, and if anything, they'd gone the other direction. And his answer was that a lot of it had to do with government stimulus, like running deficits, basically, was kind of one of the primary takeaways as to why that was the case. I think there's also probably a reasonable argument of, call it regulatory capture or lack of antitrust, probably. There's some pretty cozy, comfortable oligopolies and monopolies that exist that are just earning super normal profits. So who knows? That's a very big, complicated system to try to like ascribe to a couple of variables is quite difficult.
The monopoly thing is funny though, because even in the small caps, they're running at historically high margins.
I think low cost of debt might play a role here too, because money has been cheap.
Interest expense very low,
really cheap since 2009. I mean, it's I think that probably plays a role in there.
Corporate taxes too low.
Yes, thankfully. Let's not do away with that. No mean reversion there, guys. Lower's better.
Well, we'll see. I mean, you balance that against the guillotine risk, and maybe it's not the worst thing in the world.
And there's that.
What did you take away from from the piece, JT? What should we be looking at?
I told you 120% of my knowledge just now in the no. I mean, I think it's like I said, I mean, I think it's going to come down to a handful of companies and what do they do with their cash that's going to dictate a lot of the return on capital, a lot of the profit margin numbers, because they're just such huge companies. Like they just really like they make up a ton of the market cap, and they create a lot of the economics that is accounted for in the S&P. So as they go, so go with the index. And so I don't know. I mean, when I think about some numbers I've seen where I think starting next year, there's going to be like 500 billion of depreciation flowing through these income statements next year. That's not an insignificant number to mark against your earnings.
Yeah.
Shit, at some point that stuff kind of has to matter. So I don't know. We'll find out.
There was a paper, I think it's a 2005 paper, something like that, that the investment factor paper, where they said that basically you want to avoid companies that have these very high investment, making these
Yeah.
very high investments because they tend to underperform. The problem is that since that paper came out, that whole relationship has flipped, and the investors are the ones that have outperformed. But the full data set says that the investors underperform. I don't know. I think it's either
That's
one of
every
those.
data set right now, isn't it? Like
Well,
literally
that
everything.
is
It's
true.
like, do you
That
want
is
to be
true.
right from the last 10 years or the last 100 years? Because they're
That's your choice.
polar
That's your
opposites.
choice. That's your choice.
Yeah.
Yeah, that's exactly right.
It's enough to drive a sane man to off
When
the
the
edge.
when the going gets tough, the weird turn pro. Is that the
Right. That Hunter Thompson, when the going gets
Hunter
tough, the
Thompson?
weird turn pro. Yes.
Well, speaking of one area that has been sort of dead and left behind, let's talk small caps.
Okay.
Great
What,
segue.
let's start with this. What's the attraction of small caps, Tim?
There's not much. Most of, when you look at small caps, you can find bargains, and you know this, Toby. I mean, you kind of in the same space uh, uh, by default using the acquirer's multiple. You tend to come up with cheaper stocks, but right now we're in that phase where the stuff that you can find keeps going down. So it's just that kind of environment, at least in U.S. based stocks.
I will say that maybe turned around at the beginning of November.
Oh
We're
boy.
measuring
Here
value
we
runs
go.
in fruit fly lives these days.
Yeah. It's been 3 Liz Trusses.
It's been it's been it's been 3 weeks of not being waterboarded.
Yes. Well, I mean, and everything's up to date rather nicely, but when you look even at small caps in the U.S. market right now, if you apply credit filters, you're still not coming up with a ton of names. And as I said, what you do come up with continues to go down. Now, where outside of small banks, where I can point and say that's cheap, I want to own a lot of that. Right now, it's Europe and Asia.
Mm. And Asia, is it primarily Japan, or where are you finding things?
Actually, yeah, Hong Kong.
Tim just did a Hail Mary.
Yeah, we are. We're buying Hong Kong.
Okay.
I mean, look, I bought Swire Pacific, and I bought it. Recommended it. Bought it in my own account. Swire Pacific owns 82% of Swire's property. That portion that they own of Swire's properties is more than their market cap. They also own 45% of Cathay Airlines. Oh, and most of the Coca-Cola bottlers in Southeast Asia. So it's reasonably financed. There's a 5% dividend. What's the knock on it? It's in Hong Kong, right?
Yeah.
And China has been the quietest bull market, I think, in the history of the world, because we've all sat around for 2 years talking about how terrible China is. The properties are
Uninvestable
empty,
even.
uninvestable. The government's failing. They're not using oil. It's awful. It's terrible. And the stocks just keep going up and up and up and up. And it really hasn't happened in Hong Kong so much. We're playing a little bit of catch up, but God, it's cheap. And you look at the property markets, and they're not having the same office vacancy problems and apartment vacancy problems we're here in the United States. They have a PR problem
Mm.
because these properties are, they're still kicking off cash. As China continues to develop, Hong Kong is going to continue to play a bigger role.
Mm.
Um, if you look how close Hong Kong is to the tech centers in China, as the Chinese technology industry develops, it's really good for Hong Kong. Now, that's all the big macro stuff, and that's really cool stories. The truth is, I'm buying it because it's too cheap not to buy.
Yeah, I was just there last week in Hong Kong, and it's first time I'd ever been there. I really liked it. It's amazing. These just like basically, if you took New York and put it on an island, and or like a tropical island, and just built it into the side of the mountains, it's pretty incredible.
Right, and had no EPA overlooking the harbor and all. Yeah,
Yeah.
that's Hong Kong right there, man. But things are happening in Hong Kong, and they're pretty good. And just the
Yeah, it was
closeness to,
bustling.
yeah, they're so close to the technology centers of mainland China that I think that's going to be a big carry through. And the fact that you can buy this stuff so cheap, get paid a nice dividend. And look, I didn't put my net worth into it. Okay. And I don't recommend anybody else do. But as part of a diversified portfolio of global stocks, Hong Kong is cheap. Japan is certainly cheap. And, I'm going to have some great fun. Thursday at my son-in-law's expense because he's an economist and he's been explaining to me all the ins and outs and financial intricacies of why Japan was on the verge of failure for a couple of years now and why their banking system and the carry trade and blowing up, it was terrible and awful. And I'm just sitting here going, yeah, but they doubled and they still traded 80% of book. So I don't really care about your argument anymore. So we're still finding some value there. Uh, we own European shipping. AP Moller
Mm.
Maersk is still sitting there, and the stock is ridiculously cheap. Um, and if you just run, and we started doing this over a year ago, just take the old Ben Graham perfect stock rule, right? Under book value, less than a zero point 0.4 debt to equity, current ratio of 2 or more, pays a dividend, and it's crushing U.S. stocks. Right? I mean, it just makes the Mag 7 look sickly over the last several years, and they're still cheap.
That's a narrative violation. So
I'm sorry, my life is a narrative violation, so I'm comfortable with that.
Why are they trading so cheaply? What's
Because they're Europe, right?
yeah.
It's the U.S. is now like this massive, dominant player on the global stage, the global economy, global markets, and Europe is seen as these totally 1,000,000% incompetent, stumbling, bumbling fools and idiots who get everything wrong. And there are grains of truth in that. Okay. I mean, if I was going to write a script on how to really screw up your energy policy, right, I
yeah.
would just take government policy from Germany and a couple other nations around Europe and write my movie. Um, they've made a lot of mistakes, but you got a lot of great businesses in Europe, right? You've got, a lot of 200-year-old businesses that have seen it all and done it all, and they're still there. And much like California, as much as we point fingers and go, ha, 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 there's still a lot of people living there. And they're buying
Mhm.
things and they're buying clothes and they're driving cars. Although in California, I think that's a felony. But sorry, Toby, I had to take the shot. Europe is still there. It still exists. It's still doing well. It's still got great businesses. They still have, warms my heart as an old man, they have a dividend first policy. They like to pay dividends, right? And then you look at what's really happening in Japan, where they looked around and said, look, you can't keep doing this cross ownership, this little, gentle corporate mafia thing that we've been doing for centuries. I can remember the first time I invested in Japan, it was because Marty Whitman bought all these property and casualty companies in Japan. And Marty is one of the smartest guys that ever lived. By his own admission, he got lazy at the end, but when he was working, he was, he was killing it. And he thought he was going to go in and play activist. That was funny. Now we all did eventually make money in the stocks, but he thought he could kind of put the squeeze on them and No, they all owned the majority interest of each other. It was like this impossible thing to unwind. And activism, he complained to the government. They went, "Yeah, that's nice. What are you doing here, white man? Get out of Japan." Today, they looked around and they said, we're going to need foreign capital to do all these things. So we have to loosen the restrictions. The main stock exchange said, "Look, you got a year. Get your price up over book value, or we're going to delist you. You got to end your cross ownership." So now all of a sudden, activists are winning. Elliott actually won an activist campaign, right? This is like a huge deal, right? And we're seeing buybacks and all kinds of, 20th century United States markets kind of stuff going on in Japan, and it's really good for the stock market. And you can still buy these really good businesses with great balance sheets, by the way, for less than book value. So I know there's all sorts of double top secret financial stuff going on in the background because my son-in-law goes on and on and on about it. But I don't really care. It's like the SOFR EFFR rate that everybody was all jacked up about last week. Well, I looked at it and went, yeah, okay. That's because of Treasury issuance. Are we done talking about that now? I mean, it's all great and it's all conspiracy theory and it gets clicks and likes, and it doesn't matter that much if I can pay 80% of book value and they don't owe anybody any money and they have good credit and lots of cash. Your prime minister can be the biggest moron that ever walked. I'm probably still going to make money. So, yes, Europe and small banks are kind of really where we're focused right now.
I've heard that rumblings that Korea is like 5 years, behind Japan at this point, as far as sort of that story of corporate governance reshaping, a lot of heavy balance sheets that could
Yes.
potentially be unwound.
Yeah, and I think we'll eventually get there. And right now, Korea Electric Power is cheap. It's been cheap forever, but if you buy it when it looks like North Korea's ready to invade, I've made money every time they're doing that. It's like I want to send the guy a Christmas card and say, "Please threaten to invade." I need some cash.
He's your best catalyst.
Yeah, I mean, he's a great indicator. He threatens to invade, stocks sell off. We buy a little bit. He doesn't invade. It's the old, and it's still one of my all-time favorite market stories is the guys at Tweedy Brown. Howard Brown went out to lunch one day, and I forget which one of who was Joe Riley was on the desk, and it was Bay of Pigs, not Bay of Pigs. I'm sorry. The Cuban Missile Crisis. All of Wall Street's scared to death. Markets are dropping like a stone. The market was already down before the missile crisis. Things are collapsing. Now, Tweedy Brown this is old school value, right? They were Ben Graham's broker. They've been around a minute or two. Okay, I'm going to have to call that back. So Howard goes to lunch. He comes back. Joe's at the desk. They've got everybody's huddled around a little black and white TV where they're predicting the imminent end of the world as the ship comes ever closer. He's calling every broker on Wall Street and he's just buying and buying and buying and buying stocks. Howard says, "What the hell are you doing, Joe? There could be nuclear war. We could all be dead." And Joe said, "That's right. And if there's nuclear war and we're all dead, nobody's going to care. They're not going to be here to care. But if they don't have nuclear war, we're going to make an enormous amount of money." Firm had one of its best years ever. So,
buy on margin. You might never have to pay it back.
Right, exactly.
Yeah.
Exactly. So that's Korea's been like that for a long time. Every time there's an invasion risk, it sells off, and you can make some money there. But they are well behind Japan in making big corporate governance changes. They still have a lot of the interlocking going on.
That the carry trade thing, is that a risk to the Japanese stock market, or is that a risk to the American stock market?
I think it's a risk to every other developed market in the world,
Yeah.
more so than Japan. That's not the way the story is being told, but because the idea was you borrowed the cheap money there and then you bought stuff somewhere else. So
and their rates have been rising. Their rates are the highest that they've been in 20 or something, 20
30
years.
Way over 30 years now. It's been a long time since rates were this high in Japan. But it doesn't seem to be impacting Japanese stocks at all. I mean, it went down one day last week, but so did everything else on the planet. So,
anything in America, Tim, that you find interesting outside of the banks?
I mean, not that I'm like, aggressively committed to at this point in time. We did buy some of the Amrise spinoff, AMRZ. It's building supplies and materials, aggregates, concrete, asphalt. It's going to be a lot of building in this country. A lot. We are going to be building the data centers. We're going to be, look, you get to write off manufacturing facilities and factories under the big, beautiful disaster. Oh, bill, I'm sorry. Um, so you've got that construction, you've got reshoring of factories. There's a lot of homes that have to be built. We're millions of homes short. Um, and that's going to use a lot of building materials. This thing gets spun off by a Swiss company, by the way. Nobody cares about it. Nobody understands it. It's a great business that has done nothing but drop since the spinoff.
Mm.
So we bought a little bit of that. Let me just pull up the actual sheets here so I can talk from a position of authority. We bought Goodyear Tire and Rubber, actually, with the $2 billion capital infusion from asset sales and the fact that they make most of their tires in the United States and puts them in a very good competitive position against most other tire companies. Bought some of that before that began its run up. If
And
city,
EVs are not a threat to tire companies. If anything, EVs chew tires.
Yeah, that's what I've heard. And I'm not a big tire expert, but Goodyear is an old American company. They were doing everything right, is trying to undo the mistakes of the past. Um, it's hard for me to find a lot that I want to, be really super aggressive about in the United States right now because the indexes are at ridiculous levels. And I don't care how you cut or measure that when a 40 CAPE ratio is a 40 CAPE ratio. And when I look at credit spreads, they're about as tight as they've been. They've weakened up a little bit, but that's a lethal combination. And you go back through history and you find sub 3% high yield credit spreads and a CAPE ratio, say, of over 30. I mean, that's lethal. So I'm being very cautious, and it's got to be super cheap. We bought CarMax when it imploded just because I love CarMax.
Hmm. What are
Guys,
the other times when you had a tight spread and a high cape? Was it all
2000,
the
1999. And you can't go too much further back because you didn't really have a high yield credit spread that was measurable before then. But 2007, you got into the same situation, and 2019, you got into a very similar situation. So, and it's not a you must act immediately right now. The market's going to drop tomorrow, but it's screaming something about forward returns, and the guys, I'm not sure what this is, but it's a doctor's office. I think I have to take it. Give me 2 seconds.
emergency?
Uh, JT, we would tell us a little bit
Toby.
about your your trip to Hong Kong. What are your learnings of Hong Kong? Make benefit, glorious nation of value after hours.
Yeah, did a little Asia swing of Tokyo, Hong Kong, and then Shanghai. And generally speaking, it's kind of similar to our trip earlier this year that we did together, where you just come away from it thinking, gosh, there's so much commerce happening on this side of the planet. And that when you're living on the other side, you just sort of take a little bit, or you're just a little blind to. Um,
Yeah.
Chinese people really want to work hard, try to get ahead, make make money,
996.
build
Yeah.
businesses. Yeah, it's as 996 as ever. It's just really impressive. They're
Hey,
working quite hard there.
sorry, I had to step away for a minute there, guys.
No problem.
Yeah, I only caught part of the Asian thing, but I did. Henry McVeigh and his team at KKR, they're really good on macro, by the way. If you're only reading one macro guy, for me, it might be him.
Mhm.
Um, and one of their major themes is inter-Asian commerce. They see it as huge because of the ongoing arguments between the United States and China on trade. They're doing more and more business between themselves and amongst themselves, and they see it as like a really high return investable area.
That's interesting. Yeah, you can kind of imagine that. I mean, if the supply chains do a little reconfiguring.
Who are
Yeah.
the big beneficiaries out of that?
I'm
Vietnam, Singapore.
Vietnam, Singapore, to be sure, and I'm still doing some work on that. I haven't got anywhere near as far along as I'd like to be. So, but just
Got to be
most of
inflationary for the West, right? Because you're just like those cheap goods and services or goods at least are getting redirected somewhere else.
you would think so, but so far everything that I've thought would be inflationary for the West and for the United States hasn't shown up yet. My nightmare
We
is it
just
all
don't
shows
count it.
up at once. Well,
Well, that's
no,
part of
it's
it.
it's funny that everybody's celebrating now that tariff revenue is getting ready to go up because all of the pre-tariff rush of stockpile building is now gone. So that's great. It's going to increase tariff revenue. But last time I looked, tariff revenue was the tax that was inflationary. So it's going to be, I think the first quarter of next year could be kind of interesting on the macro stuff.
So
And
you think that's
again,
the first time they actually start hitting? That's the first time they actually start counting because everything up to this point has been pre tariff inventory that they've been selling down.
that's part of it. The other part of it is that there's a couple things. A lot of tariffs were staged in. Okay. B, according to Goldman, and I'll rely on them because they've got guys at the ports counting these things, and I don't. Corporations have been eating over 50% of the costs. 8%. The foreign nations have been eating 8%, and that's been the number, and it's going to stay the number, I think. But the corporations, if you listen to the calls, they're saying, yeah, we ate some. We can't keep doing it because it's killing like Target and Walmart and some of the other people that it's crushing margins. Well, they've got shareholders to answer to. So I think the first quarter could be kind of interesting, depending on how the Supreme Court decision goes. But I don't think we've seen the last of the tariff movie yet.
What's the decision before the court? Whether
The
they're
decision before the court is whether he was allowed to do it or not.
right.
And I mean, I know the answer. I'm just not sure how they're going to rule.
Yeah.
What's the answer?
Right.
Yes, he's allowed to do it.
No, absolutely
No.
not.
Okay.
No, in
Congress's
fact,
job.
if they vote that he has the authority, they're all going to be suffocated from tying themselves up in knots, and we're going to have to get a whole new court.
I see. So what happens when they say he's not allowed to do it?
Now, there's the $24 question. None of us know.
Okay.
Really, that's just going to be massively confusing because technically they've got to give all the money back.
Can you imagine what are they going to? Such a mess.
It's absolutely going to be a mess, and we could do a whole show on this, but we shouldn't.
I try not to follow too closely.
Yeah.
No idea.
I mean, that's
Make your head hurt.
I love macro and politics, but it doesn't make me any money. And it took me a while to come to that conclusion. And because I love to talk about the macro stuff and get down to the details and read about it and dig into it. And it's fun. And I'm from the DC area. I mean, my parents were, worked for the government. I cut my teeth on politics. I love politics, but it makes me no money. So when I have to sit down here, I mean, I'm EV to EBIT, price to tangible book value, credit rating, and I can't care about anything else. Because if I'm honest, macros cost me more money than it ever made me.
I've wondered before if like the value factor as a thing has made money because it is just relatively agnostic about anything macro. Like you're almost always buying in the face of something scary macro wise.
Yeah.
I think done correctly, I think that's probably 100% right because you're always contrarian.
Well, that's my thought too, that you're buying stuff just before it tips over the edge, but
Well,
it doesn't tip over the edge, it comes back.
Yeah, and that's one of the reasons I love the small bank area, by the way. There's a certain idiot-proof factor to this, okay? And to illustrate, after the crash of 2000, we bought a whole bunch of banks, right? Because they were cheap, and these were good banks. They were small-town banks. They didn't own any internet stocks. They didn't make any loans to Pets.com or any of that. So great little banks trading literally at half a book. This is party time for a guy like me, right? But then we got a really accelerated consolidation wave. So these things were going out one or two a day. It was fun. But as we get up to 2007, two things are happening. One, we're starting to see NPAs creep up in banks with large mortgage books. They go over 2, I'm out, right? So we're selling there. But when we get a takeover and I'm looking around and I've got cash and I need to invest it, there's nothing under book. And there's nothing with, the below 2% NPAs. So I'm literally got cash. If it wasn't for SPAC arbitrage, I might have starved to death in 2007.
Yeah.
The guy that taught me that, I mean, he's on my Christmas card list forever.
Tim, we're coming up on time. So give us the names of it's Community Bank Investor.
Yeah, it's
And
just the Community Bank Investor. That was hosted over on Substack.
The community.
The Community Bank Stock Investor.
and Tim's flagship report, which
Tim
is the
Melvin's
small cap.
flagship report. Yeah, we have our own hosting. You just Google it. It's right there. And, it's subscriptions, or we do lots of free content. I mean, we just finished a study this morning that'll go out free to everybody on stocks under 5 PE ratios that are expected to remain. It's a pretty cool study, by the way. It was a lot of fun to do. The drawdowns are not for the faint of heart, but it's actually ridiculously profitable.
And if folks want to get in contact with you or follow along with what you're doing, what's the best way to do that?
You know what? Shoot me an email, guys. Just tmelvin@gmail.com. I please email me. I love talking about this stuff, and I'll get back to you usually within a few hours.
Good one. JT, any final words?
Happy Thanksgiving to everybody in the US. Enjoy your family time. Stop thinking about the markets for a little while and give it a break, and just appreciate the life that you have around you.
Amen. We'll be back next week, same time, and then we'll figure out how many shows we've got left for the end of the year. I think we've got a few. But
You left in us.
we got a handful left before we collapse at Christmas.
Okay.
All right, guys. Tim,
Toby, thank you so much. I really appreciate it. I love coming on.
pleasure. Thanks for having you. It's been great. Feedback's been great. And folks, happy Thanksgiving. We'll see you on the flip.